Let's dive into the Fed rate outlook today. We'll take a look at how the Fed will respond next week. It's going to be a good one. My name is Paul Barron. Welcome back into the show. I do want to thank our sponsor today. That's iTrust Capital. This is where you guys can begin your whole crypto IRA concept. Maybe you haven't diversified just yet. This is one place that you can go out there and get it started. If you haven't set up a crypto IRA before, it's very easy. You can either transfer IRAs in or you can start a brand new one. So it's very simple. Go to itrustcapital.com. You can do everything from crypto, silver, gold, very flexible. Use our link down below. It's going to give you a $100 funding reward just to get started. All right, joining me today is Rebecca Walser, who is coming in as an investment advisor, but also with Walser Wealth Management. Great to have you, Rebecca.
Thanks for having me. I'm glad to be here, Paul.
Yeah, so let's get into a few points. I want to dive in to, and really this is all about Fed rate cut. What we're trying to do is get some analysts and also wealth management people to really give us some framework of how the Fed is going to address the situation next week. Right now, Fed rate cut signals around a 3% inflation, which we saw 2.9 come in. Is it the new 2%? My question to you is this. When you see inflation going up right now, the likelihood of Chair Powell faced with a cut in front of him, how do you play this right now? What would be the recommendation?
Yeah, that's a great question, Paul. And I will just let your viewers know. So I have a tax law degree. So I'm a tax lawyer, but I also have a finance degree and I have a global MBA from the London School of Economics. So I'm very macroeconomically focused in my practice. And obviously I have a lot of people on the technical equity side, but my specialty is tax and macroeconomic global policy. So this is right up my wheelhouse. And I'm so glad to talk about it with you today and your audience. Powell is between a rock and a hard place. Let's just be honest. The dual mandate that Congress has given the Fed is they are in conflict. In other words, in exactly a time such as this, where we just had the largest initial jobless claims since October of 2021, and we're really feeling the pressure now on yields, right? You can see it, and you can see already the rates have dropped. They've preceded. As I love when the market precedes Powell and what the Fed's going to do, because that pretty much tells the Fed, this is what you're doing, and that's it. But you know, the dual mandate, Paul, is the problem here, because when you're trying to sustain or help unemployment, you want to have a very lower cost of capital. You want to have a lot of access to capital. And so corporations can go out and hire. Well, if you make and you have an easy or a stimulative policy in the federal on the monetary side, then you're going to be creating more pressure on price because you're going to be flooding the market with dollars and more dollars chasing the same finite, scarce set of goods and services that we have basically means we're going to have inflation. And so these are mandates that are in opposite of each other, that are in conflict with each other. And it really puts the Fed in a rock and a hard place when you are starting to see labor weakness and you're also seeing inflation. And, you know, that is a really big problem. He hasn't had to really deal with that, I would say, in the last 5+ years, 4 years at least. He's had a really strong economy on the jobs front. And now he's having to go back and deal with that while he's still concerned about inflation with the tariffs still yet to come, especially with China.
So, okay, so you got a lot happening here. I want to go back, if you want to find the last time before this cycle that the central banks eased policy with core PCE inflation at 3, you'd have to go back to the early 1990s. I'll zoom in on that so you can kind of see that statement. And that was, you know, the internet was barely alive at that time. So that's how long ago this kind of situation has occurred. And you look at that right now, Rebecca, and I'm just kind of curious, do you think that this is going to continue to see rising inflation going into the Fed's cutting cycle if they actually agree to do it? Do you feel like we're going to continue to see high inflation?
The fact is that we really changed our monetary policy after the global financial crisis in 2008 and 2009. And we really did implement modern monetary theory, which modern monetary theory, as I'm sure you're aware, Paul, and your audience is very educated, is the theory that you can print infinitum, you can print ad nauseum, and as long as you can elect enough tax base to service your interest on your debt, not even actually the retiring of the debt, but just servicing the interest, then you will be okay. That is a Keynesian economic model, obviously. And that is what we have followed. And that is the issue, is that 2020, if we have to pinpoint one issue that will probably go back in time, all the white papers will be written 50 years from now, they will probably pinpoint coronavirus, because globally the world printed the equivalent of about 20 trillion US dollars. Not all of it in the US. Obviously, the rest of the globe did about 10. We did about 10 between both fiscal and monetary stimulus. When you put that much money in that short of a time frame, if you just look at the M2 money supply from just even March to June of 2020, it jumps exponentially, and it is never retrenched. We had M2 come down a little bit and then come back up. We had the largest M2 ever in June of this year. So when you put that much stimulus into the system, you can't have transitory inflation. And now I feel like the Fed realizes they're up against a situation where it's going to be constant easing, and the constant easing, because what has happened, Paul, is we've had the corporations, the banks, the real estate, every industry in the world, and specifically here in America, has gotten used to very cheap credit. And so that has created asset bubbles. Real estate, probably the largest, right? Commercial asset bubbles. Like if you evaluate a property on a 2.5 or a 3.5 rate, it's a lot of a difference on the cash flow discounting when it's done at a 6.5 or a 5.5 normalized rate. So we have created asset bubbles, and that means that we have to constantly grow the money supply in order to be able to sustain this. And that's the problem. It's unsustainable. So inflation is, by definition, at this point where we're at, interest now the second largest expense in the federal budget. We are entering a debt spiral. And this is kind of the interesting part of the crypto space, because the new technology frontier really is what most real economists are counting on to outpace the interest growth. So in other words, interest is growing so fast that we have to have something massive like the fourth industrial revolution come along and grow even faster. Otherwise, we're going to enter a debt spiral that is not recoverable from. It's just a mathematical certainty at this point.
Yeah. Okay. So as Lynn Alden would say, nothing stops this train is what we're dealing with right now.
Exactly.
Of course, now there are some ways you can get around this. Before we go into that, and we're going to talk about stable coins and your opinion on that in a second, I want to jump over to Polymarket real quick. This is the Polymarket for how many Fed rate cuts. I'm going to zoom in on this for you guys to see it really closely, and I'm going to highlight right there. What we're looking at right now is the probability of three cuts up to 75 basis points, 2 cuts, 50 basis points, and then we even now, for the first time, we've seen 100 basis points on the chart from Polymarket showing up. So my question to you, Rebecca, what happens next week? Do we get a quarter? Do we get 50? What are you thinking?
I think that Powell probably wants to maybe lean towards 50, but I don't think that he'll give the administration the satisfaction. And I also think that a 50 bip cut will actually make the market freak out a little bit. I think that they would be taking that as an indication that the Fed sees more weakness than what we're seeing. So right now, odds on 88.8% as of this morning that we're just going to get a 25 bip cut in this next September 17. Then we'll see probably another 25 bips in the October meeting and a final 25 bips in the December meeting, and probably pick up another 25 bips in the January meeting. So you'll have 3 to 4 in very short order in the next couple of months.
All right, so that's a full point by January. So this is still all pre-Powell's exit in May of next year. When you look at just the BLS data that's been coming in, this was Lance Roberts. He was kind of hitting on this, and the fact that we've seen this much incorrectness in overall job data, and you look at where Chair Powell is setting, because I mean they clearly either. I can't say that they knew that this was that far inaccurate, but let's assume that they did not and they were acting accordingly, holding rates for higher longer. Now that they have data that repositions them, you don't think that they would try to do a catch up? You still think that quarter is the way to go?
I mean, I think that the right answer depends on the question that you ask, right? If you ask me what is the right thing to do for refinancing our debt and controlling our interest expense, I would tell you we have to get the cost of fund, we have to get the Fed funds rate down so that we can reissue and have interest come down. But if you ask me what is the best thing to do for the solvency of a nation and to preserve the US dollar as the global reserve currency for the longest amount of time, I would tell you absolutely not an easing monetary policy in any sense, because we've already passed the point of the easing that we can sustain without having massive other changes. We've already gotten to that level, and people just aren't aware of this yet. But this is going to be a massive issue for whoever takes control of the Fed after Powell leaves.
Okay, so this gets into a lot of detail because obviously there are some people that believe Trump is on a mission to try to devalue the dollar. This would, of course, stabilize the potential of American supremacy, possibly go into stable coins. I'll talk about that in a second. But also gold. We've seen gold hitting all-time highs. And a lot of countries that have started to accelerate their accumulation of gold, that's been going for quite some time. If you look at the inflation rate, I'm going all the way back to 2016 on this chart. And, we've been able to kind of hold it until we hit, what? And that's when everything kind of fell apart, obviously because of the amount of money being printed. Is there ever a possibility that we can return to a 2% inflation as a baseline?
No. In my professional opinion, absolutely not. And you kind of saw Powell talk about that at Jackson Hole.
I want to go to a clip real quick because this is, obviously we're going to talk about what is affecting Americans right now. Higher prices are definitely hitting the American consumer. This is Howard Lutnick. Let me play this for you. Let's go to SOT 1.
Tariffs are bringing in $40 billion a month, reducing our deficit. You know how much taxes we'd have to charge Americans? They'd have that much money?
I do want.
So there you go. How much we'd have to charge Americans if we didn't have that. But in reality, we've seen inflation now up to 2.9. Looks like it's going to be on its way up. We could be paying for that anyway. What is your opinion right now on tariffs? Is this good for the country? Not good for the country?
Yeah. So I think tariffs can actually be deflationary because they can bring prices up to an extent that less people want to buy it, and therefore it lowers demand, and you can actually get deflation when you implement a tariff policy. And that actually has happened before in the United States. However, we have to have an administration that comes up with unique solutions to try to save us from a debt collapse. And the tariffs are one solution. To Lutnick's point, it replaces a lot of tax base that we don't have, but also, possibly looking at a non-true free market capitalistic idea of a quasi-public-private partnership between the government and private corporations. And with the advent of AI, I think the AI corporation is the new country. I think countries' borders become less and less relevant. And basically, when we get into the full-on AI space, it's going to be more about the corporations that run the world, unfortunately.
Do you think there's any possibility that tariffs, or that Trump could try to do a Hail Mary so that he could continue to accelerate these tariffs and do like a tariff rebate of some sort? I was tweeting on this. You look at just the amount of money that has been collected right there. I mean, this is astronomical shift in tariff revenue. And we have to understand, either they're going to pay down the debt or try to associate that with some pay down, or they got to figure out where to put this to work. Would they do that? Do you feel like Trump might try to do some little stimmy?
There's definitely been some tweets about, giving every American X amount of the tariff money. And I'm sure that the American public would love the tariffs after that, probably. But the truth is, Paul, we're not collecting anywhere near enough tax revenue to just maintain our annual fiscal budget.
Right.
So, to give us a rebate on a tariff policy that brought in $30 billion in a month, that sounds beautiful and great, except for we are so underfunded by our own, tax revenue that we don't really have the money to rebate it. It would really be more of just a giveaway just to appease the American public. It's certainly not the most economically viable option.
Yeah. So Rebecca, when you look at that and you think about the haves, the have-nots, because what we're dealing now with is a situation where people are going to have to get into assets. It's the only thing that's going to be somewhat, inflationary proof. The dollar is debasing clearly through what's happening right now with our debt. You've got Goldman Sachs CEO. I'm going to play a clip for you. I want to get your opinion on this. Let's go to SOT 2.
It's so, you sound so much smarter when you're bearish. Then I used to say, what do you think? And then I said, what are you? How are you positioned? And, I have all these bearish thoughts, but I'm 100% in equities.
Personally, right now, you
are. Because because we're about to lower interest rates into a bull market.
And do you think it's an epic moment? Is the trader that is Lloyd Blankfein buying all of the mag set? When you say you're 100% in equities, what does the portfolio look like?
I think it's a phenomenal moment. It might be. I'm not a great technologist, and I've lived through waves of technology, and I experienced things that changed the world, and I experienced things that changed our fortunes because we overinvested in stuff.
37% of total U.S. stock market right now are tech stocks. So that share doubled in the last 5 years. So you are advising clients, so how are you telling them to play this? Is it all in the tech sector? Are you looking at mid caps? Are you trying to look at gold and silver, diversification into crypto? What's your play right here?
Yeah, that's a great question. So I've definitely been a gold bug since 2020 because I could see with the global stimulus. And another thing happened with gold that people don't realize: at the end of the global financial crisis, the World Bank and the monetary regulatory global machinations that be basically came out with something called Basel III, which basically moved gold from a tier 3 to a tier 1 asset. And so you started seeing a lot of countries, China, obviously Turkey, really buy up a lot of gold, and then actually call London and the United States and say, we actually want you to deliver the actual gold. Like, no more trust. We're going to verify, send us our gold. So I think gold is a substantial play. So I do think that the way forward is we believe in equities. We really believe that this is the convergence of all things. What I mean by that is this is the global sea change over, where the US dollar will no longer be a unipolar reserve asset, but it will be multipolarity that we share with the East, and specifically the BRICS bloc and everything that China has done to really become the center of that world. I believe that's where we're headed, where there is going to be a currency shift over, and that is going to kind of occur as we get into this debt spiral. And the only option that we have is crypto and the AI frontier, robotics, quantum computing, obviously, all of the new technologies of the fourth industrial revolution that will have to merge together and really kind of bring our growth higher than our losses on the debt side.
Okay, I'm looking at the treasury model. This is why corporations are now looking at, and nations are now looking at holding crypto. I'll zoom in on this for you. Mainly, it's a hedge of inflation, clearly, what we've seen there. Diversify currency exposure, that's something that I think everybody's, the liquidity side of it and the digital segment, those are all very, very attractive, when you look at how this plays out. Sovereigns, people are starting to move in this direction. Do you think we'll see countries and corporations, we've already started to see these digital asset treasuries growing like crazy on Wall Street here recently. I mean, MicroStrategy, you've got BMNR with Tom Lee going nuts out there with Ethereum. Solana just hit the street. What's your make of this? Do you think we'll have businesses starting to invest more into cryptocurrencies, gold, other hedges out there other than the US dollar?
Yes, because they're going to start to see the inability. It's going to become more clear in the next 18 months, our inability to sustain our interest payments with just our regular tax revenue. And again, the Treasury auctions that the Treasury has to run right now, things that they've never done before. And so, yes, I do think that corporations, CFOs are saying, look, there's problems here in the U.S. We can see the divergence and the move away from the U.S. to the East, to the BRICS bloc, the BRICS nations. There's 40+% of GDP is now represented by the BRICS nations. So that is problematic because we in the United States don't have as much. We are less now than the BRICS bloc put together. And that's a concern. And when you have, that kind of problems amidst geopolitical problems, obviously with Russia and the U.S., India and the U.S., now China certainly and the U.S., which I would say would be the biggest problem, you will see corporations that are doing stuff globally and internationally to get away from the risk of the U.S. dollar.
Yeah. Okay. This is getting pretty crazy out here because how long do you think we are before we see these kinds of major moves? Is it within a 5-year cycle, especially in what we're dealing with right now? You think it's that close?
We see massive changes in 36 months or less, and I would expect massive changes even in the next 18 months.
My last question to you is this. You said we're going to see a lot of quick moves here. One of the things that is happening is NASDAQ, of course, filed with the SEC. They're going to tokenize stocks. So this is going to let investors trade equities on-chain. This is full shareholder right. This could change a lot within how we're going to see stocks traded very quickly.
Yeah,
and then
absolutely.
So I'm going to play a clip of Adina Friedman, who is the CEO of NASDAQ, and she goes on this. Let's go to South 3.
So this morning we announced that we're going to be bringing tokenization into our markets. So making sure that equities are tokenized and traded on market, in the markets.
24/7, 365 equities, just let it rip constantly.
We handle like 3 million messages a second. It's hugely scaled. But then at the same time, once that trade occurs, there's a different process. And then the post-trade process, as we know, is an area where tokenization really shines.
Famous curve, which is like you get this early font of insanity, and then there's the trough of disillusionment, and then you grow through. And does it seem like crypto is actually in blockchain? It's finally real.
We finally have this convergence of regulation between the traditional markets, the digital markets. How do we bring it all together to frankly advance all markets?
How do you justify it like, hey, it's going to be worth the fact that none of us are ever going to sleep again?
Yeah. First of all, I started at NASDAQ in 1993. And back in the 90s, we had a vision to go to 24/7 markets. The technology wasn't there to do it.
All right, so do you think that will help, Rebecca? I mean, are we going to see an age now where tokenization of securities, movement on chain, and this whole new evolution where we're going to be able to possibly even use this in yield, other instrument-bearing platforms out there for loans, et cetera, on our assets? Is this going to help at all with what our situation is?
Well, I think it's great that the electronic exchange index, group at NASDAQ is the one to move with this first. And it's funny because Interactive Brokers, is one of their biggest things is, you can trade 24/7. And it's a big draw to people. It really, truly is. As long as there's regulatory framework around it. And what regulatory framework? Are you dealing with, a token that's being issued under the U.S. regulatory framework? Or is this a company trading in Hong Kong and it's a different regulatory framework and they don't have the reserves? So it's just the tokenization has to be, people have to buy into that. And as soon as they do, and I don't know that they actually, a lot of people, your viewers, yes, but most average lay people aren't going into the weeds and following out what's really happening under the curtains with the blockchain.
Hey, well, that's what we're here for, is we can help them get there. And last question to you, and I have so many, actually, I really want to go down the gold idea with you, but I'm thinking ETH and Bitcoin. I'm looking here at the two titans that are Ethereum and Bitcoin right now. That's Michael Saylor and, of course, Tom Lee, both of which have pretty much put this on Main Street in terms of now investors getting exposure to this. If you had to play right now, and you have a lot of investors that come to you for this, would you go Bitcoin or ETH, or would you diversify?
Obviously the OG is Bitcoin, but Ethereum smart contract, platform and their implementation on the stable coin and how stable coins are leveraging the ETH universe. I think right now I'm going to have to, I know it's been maybe not as in favor as all of the new hot ones, but I think I'm going to have to go with ETH on this because of the development of the tokens. Yeah.
You're a Tom Lee fan. Well, good for you.
I'm both, actually.
I would probably have to join you on that, just in the sense that there's a lot of upside there. But Bitcoin to me is still a digital gold alternative out there. That we'll get into. We'll bring that to you guys for another question about what tokenized gold could look like. Rebecca, it has been great having you on. Thank you so much for coming in today. We appreciate it.
Thank you for having me.
You bet. All right, you guys, if you are not part of the Diamond Circle, make sure and get in right now. You can, of course, join that for absolutely free. It's our own private group. I do our Barron Market Edge, which is my personal email out to you, what's happening in the market, how we're seeing things move, and also a lot of the research that we do. It has a lot more depth than what we just deliver here on the show, the best we can. So get in on that list down below. It does help. Also, if you're not following me on X, do that. It's at Paul Barron. We'll catch you next time right here on The Paul Barron Show.